management agreement franchise session, which model and what considerations to do. My name is Scott Antel. I'm a longtime hotels lawyer, always in emerging markets. I'm based in Dubai with the international firm Brian K. Leighton Paisner, a recent name change after a merger. I've been working in the hotel sector, again, in emerging markets, Russia today, Middle East, Africa, and quite a bit in Turkey and elsewhere. I've been 25 years, everything from hotel management agreements, franchise, leases, acquisitions, disputes. With me today, I'm going to have our panel introduce themselves. First, Hala.
Good evening. I'm Hala Matar Choufany. I'm the president of HVS Middle East, Africa, and South Asia. In a great position in a way that I get to work very closely with owners to make the right investments, but we also work a lot with operators to make sure there's alignment. And it's going to be interesting to discuss post now all the presentations, the impact of choosing the right brand for your investments.
Good evening. I'm Jad Shamsuddin, Managing Director of the Hotel Division of Al Hokair Group, Saudi Arabia. Being part of this is because simply we do have all type of models in our company. We have management contracts, we have franchise agreements, and we do also have our own brands with which we manage our hotels, but also third-party hotels. And that's basically what we're going to discuss today.
This was supposed to be a round table. It's a little too large for that, but I'm going to encourage you to ask questions, be interactive. When the three of us talked about this session, we discussed about how the industry has changed substantially. And you can see a number of the things that have changed. And we'll come back to this. I want to go through these, and then we'll come back and visit them in the considerations of what model to choose. Looking back 10 or 15 years ago, and please step in, both of you, versus today, before management contracts, the terms were very long, 25 plus years, not even mentioning 4 seasons where we get 60 or 70. Today, you're seeing, even with the larger brands, shorter terms of 10 or 15 years. The fees, the old classic, it was the 3 and 10 base and incentive. Today, certainly lower base fees and the tiered incentive fees. Many years ago, budget approval by the owner wasn't possible. Today, that's almost unheard of, although the brands try to claw back a few items that they won't allow for budget approval. We're seeing in the region key money, and even more frequently, owners' priorities to allow the owners to recoup their debt. The difference today, all of these things are pointing to this is no longer an emerging market. It's a developed market. Owner profiles, there were many inexperienced first-time owners. Today you have many owners with multiple properties, asset managers, and experienced on-ground staff. The staff expertise has improved. We will be doing some operator bashing here, but one of the things that the brands bring everywhere, especially in developing markets, is extremely good training, and they leave a legacy that's very valuable. That's one thing they've done. The presence of operators on ground today with local offices for everything from technical services to central services, revenue management, very important. The economic environment, it was much easier before. Today it's higher costs and greater competition. The difference in operators today here and worldwide, before there were fewer brands. Today there are many brands, and then with consolidation you have the mega brands, often overnight competing with you next door. Traditionally in emerging markets, franchise is often said, oh, it can't be done because you don't have the local expertise. That has changed. You do have greater expertise today. You also have the emergence of third-party managers. The distribution model has changed. Remember, the old days of 800 numbers and tour guides, AAA tour guides and the like. Today, those are outmoded systems. With the advent of the internet, online, and the OTA model, everyone can get into the system and have distribution, albeit at a price. And then technology. Before, I think 10, 15 years ago, there was the emergence of clusters and economies of scale. Today, much technology is key with mobile apps, the booking systems, clustering, but online cloud accounting and the like. So all of these things and these changes going into the points about choosing what model for your hotel. And first of all, when you're thinking about it, is do you need a brand in the first place? And then if you decide yes, which brand, and then which model. And I guess looking at both of you, because you advise new owners on this all the time, and you consider it every day in your business. So what are these factors that you look at when you advise an owner? And let's say we're building in Saudi, and we're looking at a 4-star property. What would be the things you would advise owners when I come to you and say, what should I do with this property?
The simple answer is it depends. And I know many owners don't actually like this answer, but it does depend. And we tend to also argue that an operator that would do extremely well in a certain market in Saudi Arabia may not be the same good operator in Mecca or elsewhere. And hence why the simple answer is it depends. It's a function of what is it that we're trying to achieve? Are we relying on the actual operator to drive demand from outside of Saudi Arabia, and hence the need for an international operator? And it depends on the visitation. So who are we attracting? Are we attracting people from the GCC or from Europe? You know, talking about the distribution channels, this really plays part into our recommendation. Mecca and Medina in particular, for instance, because they're less dependent on the main channels and perhaps more dependent on tour operators as well as certain visitation from specific countries, and a different operator may be better suited. These are the considerations in terms of what do we favor if we were to go for a brand. Now, whether the question is, do we have to have a brand or not a brand, is something obviously we need to discuss further, because it's all about, again, the market cycle, the ability of the owner to operate without a brand, both on top line and bottom line. And I don't want to hijack the whole conversation because these are big titles, so we will discuss them. But it is really every opportunity, although we as consultants, we are told we actually just advise the same way. Every opportunity does carry a lot of different assessments.
Well, it's interesting when you talk about Mecca, that's almost like the old school model, travel agents and tour operators, isn't it? The 10, 15-year model. Less requirements of a distribution system or OTAs and the like, which would be different from other cities, the non-tourist cities. And Jad, when you're looking at with your properties.
I think being associated with a brand helps you start the business faster in principle, because the brand is something that's ideally established. Now, we just saw in the pitch to owner that Misk by Shaza was on the top of the preferred brands, despite there has been more established brand in the presentation. But and it's like a local brand almost, targeting the region in principle. So it doesn't mean to be a strong brand, but being part of it will help you kick off faster. If you are to establish a hotel without a brand, in my opinion, it may take you longer to enter the competition. That's the only thing. But you might end up beating the competition or really competing with the market. But it is a matter of time to prove your presence in that market. That's what I believe could also, it doesn't mean that, yes, we need a brand, but it means what the owner or the investor is, or what is their desire to achieve from that investment. They could be starting, accepting to slowly penetrate into the market and then from there grow fast. Or they might decide, no, you know what, I'll get a brand that's gonna immediately drive business to me.
I guess it depends on the city too. If it's a city with no international brands, and you're the only game in town and a first mover advantage, you may not need a brand initially, particularly if it's an industrial city where most people who are coming in call up and say, I need a hotel room, and the local company they're visiting is the one bringing in the guests, or it's the only respectable place to have a business meeting in town, and so locals gather there, and it generates the interest in itself. Now, later on, as that city matures and you start getting competition, then the brand has an attraction of the distribution system.
True, Scott, and the brand is a promise. So also, when you want to associate yourself with a brand, there's a promise that's given to you before you do that, and you expect that promise to be fulfilled. And that's often a financial promise that comes with delivery of results that the owners would accept to partner with that brand in return of that number. If it doesn't work, then it's a choice that's been wrongly made. And if the owner doesn't want a brand, that's also a cost to be associated with it. That's the time you need to pick up.
So Scott, if I can just add to this list, I mean, the question when I answered it, it was more within the KSA, because it has very different dynamics in terms of booking and traveling in, not the least the visa regulations. It's not your traditional open market. But it is obviously something to consider as, you know, when you're in other markets, do you need the brand to drive the top line? Do you need the brand to drive top line and bottom line? I think the times have changed drastically when we compare to 15 years ago. In what is today an established market, even the behavior of the traveler has changed. In the past, there was a lot of comfort with staying with brands because this is what we know and this is what we trust. Today, we are much more well-traveled, and there is the OTAs and the bookings.com, and there is more experience. And then the question here becomes, is someone actually going online wanting to stay, whether in Dubai or Jeddah, and will make their own choices irrelevant of the brand? So is the brand now promising to fill up volume, which is perfectly fine, but it's also become much more expensive. So is that brand also able to manage costs? I mean, in the pitch earlier on, we spoke about development costs, which is great because we need to see that there is some sort of a commitment to managing the upfront cost to open a hotel. The real question is over the 10, 15-year period, what is the operator doing to the GOP, to the bottom line, so the investor can actually repay the mortgage or the financing or have the positive equity into the asset. So it's become much more complex, really evaluating how do we choose brands and why do we choose different brands for different cities or different asset classes.
With the rise of the OTAs, I mean, everyone now can get distribution. Before, without the brand, you were kind of anonymous other than these travel guides and the like, whereas today, an unbranded hotel can be right up there, right below one of the brands on them. It's an expensive distribution system, but as you say, branding also has its costs.
Right.
And those costs have increased as the operators have lost the customer to the OTAs. They've had to claw it back through frequent guest programs and the like, and those can be quite expensive, over 50% of your fees, because usually the frequent guest programs are 5.5% of the folio, which is probably half the base and incentive fee you're paying. And yes, that goes to, you may get redemptions at your hotel, but not everybody wins in that scheme.
Well, yeah, you're right. I mean, with the advanced now OTAs and being accessible to almost all hotels, that's securing a good fraction of their business. But we also need to recognize that brand is also delivering from its own system. I mean, most of the strong brands have a very strong loyalty program, and it's conditioned to booking from the brand.com, so you can take advantage of the loyalty program and accumulate more points. And that's why the customers that are loyal to a specific brand are booking on their website. If you take that out, you still lose a fraction of a business that comes because of the brand. But it doesn't mean, unlike a few years ago, yes, when Booking.com or Expedia or Travelocity wasn't that strong, your presence would be minimal to the world by Aziz network. Now it's much more open. Some hotels have over 70% generated from these main channels, which is a lot of business without having a sales force, without having a lot of people going to do direct sale. That's a saving in return. But the brand is an additional source of income. It's not the only source of income anymore. That's basically how I look at the necessity of being affiliated to a specific brand that first enhances trust, second, produces for the hotel owners. If it doesn't produce, then the need for that brand is a little bit less important.
And I think if I can just add to that from a consulting standpoint and looking at numbers, I mean, there's no doubt we sit here today looking at 52 cities in the Middle East last year where the rate has dropped. And every operator will acknowledge the fact there's more supply, it's more difficult economic conditions. We keep talking about RevPAR. The truth, I think, moving forward is that, or at least I'm proposing, JOPAR becomes even more relevant. So we're looking at the gross operating profit and how a certain brand is doing versus others, not just on their ability to drive in the volume. And I keep bringing up this point because oftentimes, and I've always argued that if you're not in the hospitality business, please get a brand. They know what they're doing and they'll manage. But today the times have changed. The operators also have to adapt. If there isn't much room anymore to drive the top line, some of the operators out there may not guarantee you a driving the top line, but what they can help you do is minimize costs, increase efficiency. So if you're not pushing the top line, at least your bottom line is safeguarded. And I think this is, again, what when we talk about evaluating those brands, it's not just about how many people will come and book, but once the additional rooms come in, how does it trickle to give more profitability, or are we paying much more expenses that we don't necessarily need to do anymore? And it's really re-examining these contracts, re-examining how we are partnering with these brands.
I totally agree. I mean, the contracting model has changed over the past period and will continue to change. And there should be more flexibility to those experienced owners to be involved in the business. At the end of the day, the money is the owner's money, and the losses are the owner's losses, and the profits are theirs as well. The operator is never losing by being affiliated to a property. That's a fact that is kind of partnership, but in case of bad times, the owner loses. The operator has a bit of reduction in income from that property or from that market, but they don't lose in reality. The control of the owner on their property has to vary based on their capability to interfere in the business. Operators are definitely the expert. Most of the owners go to operators because of the know-how, and they need eventually the brand and the distribution system and the loyalty program. But many other owners have become experienced enough to do all of that by themselves, and that's where those small chains have also grown up, i.e. locally, and they have been doing absolutely great. They don't need to be affiliated to big names or even to big systems or large online system. And they are basically taking the full responsibility, the branding, and the profit and loss issue. A brand or an operator has definitely to give more flexibility to the owners. That's from what we have learned in the past 2 years, the difficult times, a lot of exposure to losses, big commitments to the banks to be paid back, and eventually leases or return on investment to be calculated. If this is not going to change, I believe investor will have more tendency to find alternative solution or pitch to new operators that are less expensive and more flexible with them.
This, and then perhaps this is a criticism of the lawyers. We're talking about management contracts and franchise agreements. These are 50-year-old tired nags that have virtually the industry. Every conference you go to, they talk about this ever-changing industry. And then the management contracts, same old thing. I'm doing a rebranding, or not a rebranding, but an extension of a property that's about 25 years old. And I looked at this old contract, and it's not much different than the one they're serving up now. And the distribution system has changed. As you said, the The owners and sophistication has changed. There's more professional advisors out there, asset managers and the like. The issue about who controls the data today. I mean, the data, if the owner takes the property back, is essential. But that's not what these contracts say. Well, the old ones don't even talk about data because you didn't have the internet. So that is an area that is, I think, in need of a serious revamping. And you can criticize the lawyers for that. We are just rolling out the same tired old documents. My excuse is I'm put on a fixed fee by my owner clients, so I don't have the budget to do that. So blame the operators for not updating. But getting back to this cost thing, over the time, the return on investment, what would be your ideal model then? I know it depends, but I think there's a suggestion that the pure management operator model may not be best for that. If you have a relatively sophisticated owner who has engaged asset managers and the like, what would you be inclined to do?
What, you're ending the session or what?
No.
You want one answer and then we
No, we
have
can
a
go.
coffee break? No, it's definitely there is no answer, one answer for that. In Saudi, considering our presence here, both models have been successful in a way. We work with several big names, big operators, some of them with franchise model, others managed. And we are honestly happy with both models. Those managed have learned with time that we know the business, we know the dynamic of the business. They have shown great flexibility when it comes to dealing with us and to understanding our challenges. Definitely the cost part has been spoken about, and we have managed to reach something that puts us on a common ground. We also recognize that their presence with us, especially in difficult times like now, the past 2 years and probably this year, is still delivering results that are better than if they were not there. These are from the managed perspective. From the franchise, and because we have the know-how, we have the right team that can manage, eventually we have been very strong in containing costs. And that's one of the main privileges of being on a franchise model. You can decide how you want to manage, provided you don't jeopardize the brand standards or the brand requirements, which is a little bit easier because you can do these centralized services, you can benefit from being a group with several franchise property, and that gives you more autonomy to take decisions rather than if it was an operator having to manage several properties under the same brand but with different owners. They cannot do what we can do. I believe in bad times, to give you a little bit of direction or to partially answer your question, franchise sounds more profitable to the owners. But in good times, when the business is back and demand is there, managed model has been very effective because there are opportunities, and being part of a big network and with an international company that has much more reach than being alone as a franchise model that can grab you more business, it will be to the owner's benefit. So I'm not trying not to give one answer, but in bad times, franchise in our case has been more profitable.
Can I just
Yeah.
add to this, to share an experience, which is exactly what Jad has just described. We have a client, without disclosing the details of the client, that actually has been managing their property, beautiful property, great facilities, but they don't seem to be doing well. We were called in to do our operational assessment and advise exactly that. Do we go out and get an operator under a management contract? Do we franchise, or do we continue to operate the way we are? I'll tell you what the conclusion of our study was, and that should answer how do we recommend, is that when we've done the operational assessment, we've obviously discovered two things. One, that they are finding it challenging to fill up, so that's on top line, occupancy and F&B. But more importantly, even when the occupancy is there, it is quite challenging to control their expenses. They don't have economies of scale. They don't have enough properties to be able to share some of these costs. So our recommendation, although they wanted to go out for franchise would cost them more, because what franchise would do is help them plug into a system, potentially selling more rooms, but that doesn't necessarily mean that this will assist them control their expenses. So we are working actually now with an operator to provide a franchise. And that's the, in an ideal world, 5 to 7 years, where someone takes over, manages the property, teaches the owner, and then franchise it out. Because the risk of franchising when the owner is not necessarily capable is actually very harmful.
Absolutely.
It
that
is
would
harmful.
be a big mistake.
Yeah.
That's totally correct, Hala. If you franchise to the wrong owner, that's a big problem for both.
Right.
The brand, the operator, reputation, and the owner, because they're gonna mismanage the property and they're gonna incur more losses because of their lack of experience. And I believe operators or brand owners definitely are very careful in to whom they're gonna franchise, just to avoid getting into this. Nobody wants to put a logo on a building after 2 years, take it off, because that's not gonna be good to anyone. So this is one of the decisions also where the operator has to make to whom to franchise and which brand. I mean, let's look at most of the brands that are on the franchise table now. They're not the upper scale. Nobody, I mean, very few would risk and give their most valuable brand as a franchise. They want to keep control over that. And it has to come with a cost, because upscale brands are not for cheap business. It is for certain clientele, certain profit margin has to be expected from it, and certain investment. So they don't jeopardize with the brand when it comes to that. Most of operators are looking at the 4 stars, maybe, below the 4 stars as well to franchise.
Let's distinguish between a franchise where the brand gives the system and the brand to the owner and the owner runs it, versus the franchise where you have a professional, unbranded third-party operator running it, which most of the franchises I've worked with have been that way. And in my experience, they have been much more profitable hotels, where you get a third-party manager with, they need an economy, a certain scale, 5 or 6 hotels to get a base. And the local experience in the market they have, plus the ability to centralize the back of house sales, whatever, their economies of scale they generate were phenomenal. And they were running Marriott's in the same city at a far higher profitability than Marriott was managing the property, because they knew the market. They knew when the seasonal holidays were. And the brand comes in and they fly in a GM that's not familiar with the market and doesn't have that long-term experience.
Correct. Yeah.
That's a different model. Now, the fees were higher by the time you paid the third-party manager and the franchise fee to the brand, but they delivered it back on savings.
Absolutely.
In managing the property.
Absolutely. I believe this is normally associated with more conditions from the operator to ensure that the third party, or the brand owner, to ensure the third-party operator will remain operating for the contract period. Cannot be appointed at the beginning and then after 2 years they exit. This has to be clarity, I'm sure,
Right,
from your
and they'll want
perspective.
an approval of who
you're
is going to
normally-
be the subsequent operator. If it's handed over to the owner after this training experience, that they get an approval right, or they get an approval right on the
I think that's a model that would work pretty well in that part of the world. Keeping the owners in control through professional people that work for them, instead of being tied with a contract that gives them little or no control in some areas. That would definitely please them, considering the way we operate and we do business in the Middle East.
And this was a third-party manager that brought Marriott and Hilton to Russia. And one of the reasons it was done, it was because the country risk initially in the 90s. But talking with him, he would say the difference between me and the brands is, he goes, as a third-party operator, I work for the owner, and the operator works for the brand first, and that's the difference. And the relationship they had with the owner was phenomenal, and the authority they were given. He was made the general director of the company. He had full discretion on spending and the like, with 15 hotels, and it was because of that and these economies of scale, the bottom line more than covered the additional costs. Let me ask another thing. Going back with brands, when I'm thinking about an established brand in the market that, I don't want to be another one of many in the market, but they've got a local presence in the region and experience versus this, I was traveling in Asia, I found this really exciting brand, I'd like to have them here, but they know nothing about the region, they have no local base. How do you balance that off when you're advising clients? There's the novelty benefit and maybe a great new product, but complete lack of knowledge of the market, and that's particularly true here.
Yeah, it's true, and oftentimes we have to deal with that. It is as simple as it's their investment objective. Oftentimes, owners are actually willing to let go of a couple of percentage points on IRR because they feel very strong about having a brand. Perhaps a couple of years down the road, they realize the financial implications. But that, if that is the direction they want to take, obviously, considering that there is an element of how this brand is going to add value. I mean, essentially what we do beyond negotiating with operators is looking at the impact of any brand on the exit value. And as a financial consultant, I cannot factor that in. There are brands established, and that's driven by their GOP, that will carry a 30% premium to other brands. Ultimately, we say the client can choose. Now, my role is obviously to say, how is that going to impact the value? But we've seen a lot of examples in our market, at least, which is the Middle East, where brands were from all over the world without necessarily the right alignment between visitation and that brand.
Absolutely. That's one of the pains of having a brand, especially on the franchise model, because that doesn't come normally with restriction on geographical presence of the brands versus your own location. And you end up pitching for a brand, taking one that you believe can be the perfect one, that doesn't have a lot of internal competition. But after a few years, that brand owners signs and start operating many more similar brands in the same market, and you end up the business that we, the owner, need from the operator, which is basically the online revenue and the loyalty program revenue, that it starts to be distributed to more properties, especially in markets that are saturated with demand or not showing a serious growth in demand. That's on the franchise. On the managed, eventually, consultant can normally protect the owner and make sure that within 5 kilometers or mile radius, there should be no other competitive brand. But look at the mergers that have happened recently. It created a whole chaos when it comes to internal competition and sharing the same pie of business from the database of clients that probably increases when you merge, big time. But it's still, the distribution is becoming a smaller portion to each hotel. And that is affecting the brand promise. And that's where most of the challenges between the owner and the brand or the operator starts. It is a matter of, I signed with you, I expected this, I've been getting this even, and it is only decreasing with time. What are you going to do about it? The contracts, as a lawyer, are not something you can change easily, you cannot cancel, and you end up with a very bad relationship. And in this part of the world, relationship is key to success. Contracts are not. It is how both parties, it's not like in Europe. Sometimes it's a contract that runs the whole business, but I guess. But in the Middle East, the personal relationship and the business relationship is very important, so the business is sustained and continue to grow or survive in bad economics. When this is not happening and when there start to be two parties fighting and trying to, wait for everybody's mistake, then this is not good for the business.
Well, relationships definitely in the Middle East, but that's true in a hotel relationship anywhere. As one of my best clients has said, he goes, I cannot and will not run a hotel when the owner doesn't want me there, irrespective of the contract. He's going to pack his bag, collect his fees, shake his hand, thank you, and leave, because without that relationship, it just won't work. I want to go back to one thing, but do we have any questions? this gentleman. Do you have a microphone? Right here.
Hi there. This is Fahad Al Musa. I'm an owner actually of several properties in Mecca Al Mukarrama, western region of Saudi Arabia. I have one question actually about the brand itself. The last 6 years, I was negotiating with a lot of franchise, a lot of brands. And I decided 5 years ago that I will build my own brand because of several reasons. One of the reasons that my properties has not that, let's say, perfect location. You know, Mecca is centralized by a holy mosque. And if you are like radius 1 mile, let's say, you will not get any good brand. My question is the following. Why the brand protect itself, okay, by getting the perfect location and refuses the, let's say, the far one? If my property next to the holy mosque or has a view with the holy mosque, believe me, I don't need your brand. Okay? I am very, let's say, amazed about some brands have a celebration that they getting a perfect ADR or the perfect occupancy rate and their view in the holy mosque. With all due respect, any kid has a new brand, he can do more than what you did.
Right? Brand owners.
Okay.
Answer.
I'm talking about one special city. I'm not talking about other cities. I know their value proposition. I know what their add value is, but Mecca is different, Medina is different, and all seasonal, let's say, some resorts on the ski in the Alps or in the other, I think they have the common. That's it. Thank you.
Can I perhaps just address that? I'm not speaking for the operators, but just to say that, 6 years ago or even 8 years ago, that was common. I'm not sure what their strategy was. What I can tell you for sure is that everyone wanted to be in close proximity, and they came into the market with their luxury and 5-star brands. And therefore, there was a preference because also from an investment standpoint that they wanted to be closer. Today, actually, if you look, we're working on a number of properties within and outside that with the growth of the Mecca market and different segmentation, there is much more brands that are settling within the 2nd tier and 3rd tier. It's also a function of what are they bringing to the market. Are they bringing the budget and their mid-scale versus their luxury? So that's at times where there is a disconnect, not to be answering for them. But how is your property doing?
They're doing good. They're doing good.
Right.
I've challenged a lot of elements, and I passed them. What I need that time is a brand shake my hand, okay, and let's create a value proposition in that location. I know it's hard, but I need your help. I will help you. I'm very flexible. Let's do something. Why you are so scared about your name and brand to be there? That's it.
I would add, I would add just Fahad to what Hala said. The brand owner certainly has a strategy, and their presence is not always related to the owner's desire to work with them necessarily. They might have interest to be present in a different location or in a different type of building. It's not like the brand owners are ready to jump on every opportunity they want, especially if they're strong enough in that market and they don't want to create further internal competition, as we spoke about minutes ago, and create issues to other owners that might be more valuable to them financially. And that's where sometimes they avoid. I don't know your property, so don't get me wrong. I'm not trying to say your product do not deserve to hold a good brand, but market now, for the past year, everybody has been going to Mecca, and everybody has the largest properties in their portfolio open in Mecca. If you maybe opt to new brands very eager to enter this market, like some of that have been presenting an hour ago, definitely you'll see more interest from them. That's only to answer what would be the opportunities in your case.
By the way, the last year I was awarded the best hotel in Saudi Arabia, 3-star hotel.
Right.
Great.
That's talk aside.
Question over here. Yes. Get the,
But he asked first.
yes.
Rami, be nice.
Louis. So Louis disagrees with me. So thank you for your, I guess, your question or concern or frustration. I can tell you that we share some frustrations that are similar or reciprocated the other way. I think my biggest issue is, what do we define as a good brand? I think I'd like to start there, because 6 years ago the issue was, while all the luxury brands wanted to be on the first circle, front line, etc., a lot of good brands, quality brands, mid-scale brands, we're mid-scale operators. I'm hopefully talking on behalf of a lot of mid-scale brands. We see value in not the front line. We understand the front line in terms of cost of the real estate is extremely expensive. We understand that there still is value if you're the second line or third line. The key component, I would tell you, from brands, and maybe I should not say this, is 10 years ago we did not understand the Mecca market as well as you did. I think we've been able to adapt ourselves, hopefully, over the last really 5, 6, 7 years in terms of how we operate, in terms of being more flexible and, because the seasons are extremely volatile. You have 3-4 months that are extremely strong, and then you've got, essentially you make or break your P&L across 3 months. And I don't think we understood that 10 years ago. I'm generalizing, of course. So there are brands that are interested. I don't think you talked to some of them.
Huh? Now sales started.
All right? I'm not trying to sell.
You grabbed attention for
I'm not trying to sell. I want to also, Scott, sorry, I think you were generalizing on one point where you say brands are, and again, this is not talking about Louvre hotels. When you talk about the brands work for the brand first, I'd like to think there's several brands, several companies that are bottom line focused, which Hala touched up on, where the strategy is not top line, bottom line. And I think we keep our owners happy with that strategy, especially in the mid-scale, by being bottom line focused, which de facto is in relation to being primarily focused on the owner. Of course, we want the brand to do well, we want to make money, but I just, generalizing but there's a lot of talk all the time about the top 2 hotel companies in size, etc. Without naming them. They're fantastic, phenomenal operators, but then, then we just, which have different strategies to drive different types of returns, and not every owner needs the same type of brand, I think, and which you guys touched up on as well. So I don't like the generalization, if you don't mind me saying.
All these sessions always, at these events, always there's an operator bashing element. And I prefaced at the beginning that the brands, especially coming to a new market, they bring an awful lot to the element of training that wouldn't happen by locally. The revenue management, many things, and they leave a legacy that helps local brands and groups move on. So it's not entirely operator bashing. We talked before that it was interesting, the session before, that MISC was the victor, and that probably goes to Chris's debonair, charming presentation style. But you were the only one of the presenters that was offering a localized product. And that's very important in this region.
It tells something, yeah. It's not necessarily about the big names.
It wasn't about design, it wasn't about back-of-house savings, it was providing a product that was localized.
That's
And
true.
that, when you get into larger brands and brand standards, that's less difficult to achieve.
I mean, my view is that there isn't anymore the same need for consistent brand standards. The new traveler that I spoke about earlier on actually wants to experience a different experience. You walk into the same room and it could be any room today. And while I understand, yeah, brand standards are important to some extent, especially as they relate to health and safety, it's about being innovative. And it's also, I think, with MISC, again, not passing a judgment here, but it was the audience that can relate to the story. Now, I wonder if we were in Berlin and he would present how many in the room can relate. And this is about localization. In this market or in the GCC market, this is a brand they can relate to. Somewhere else, potentially another brand, and there is more value. And that's why, you know, the whole conversation goes about, you know, on every occasion, there's a different economic exercise that is done to really identify the best fit of the operator and brand. But what I wanted to comment, and I think we mentioned briefly in the beginning, that a lot of those presentations are obviously now speaking to owners in the fashion that we understand the cost involved in developing 5-star and luxury, and hence we have a 3-star product, and now almost every 3-star room is within the 80,000 to 100,000, which is fantastic. But I think it was Campanile, or I don't know which presentation, had a robot and few other technologies, and really the key questions are, with this, are we saving another 10, 15, 20% in distributed expenses? I think this is what's going to be also relevant once the property is up and running, as to how much cost savings is going to happen.
I would add one thing. I believe, the way Chris presented MISC was very straightforward and very clear. And that's what most owners want in their relationship with the operator. He mentions the cost of the product. He mentioned what average rate variances he can offer to the owner versus similar competitors. And I think you mentioned the ratio of staffing. Not sure if you mentioned any GOP or return on investment, but that is one thing that I believe most owners in that room were like, okay, we know what MISC will deliver. It's not like the other didn't, but it's about how it was presented and what was on the slide. It is 3 minutes, and this is what you got right now. It doesn't mean if we start talking to Chris and then start looking at the business plan and the contract and the type of relationship that you're gonna have, we will end up signing with him, as an example, of course. You mentioned that you have local team, which is pretty important. We know that for many, many owners, they want to be close to the operator. They want to be close to the decision maker. Who mentioned the right access to the CEO? You as well, so you hit it right. This is what owners, especially unexperienced owners or owners under financial pressure, that they need to have a quick answers and they need to have clarity on what they are getting themselves into. This is why I believe it has grabbed the attention of voters. So, and the reality is not only with that 3-minute pitch, the contracts itself, management contract are that thick. Let's really look at how many owners are spending time reading all the contracts. Yes, they have their lawyers, they have their people, but at the end of the day, we go back to where we are and where we come from. There are decision makers, and they're not lawyers.
They're
not lawyers.
Anglo-Saxon contracts, which probably a quarter of the provisions aren't even enforceable in a jurisdiction, even if it's under an English law contract. They won't be, part of it won't be enforceable. One more question, then we'll take some more questions from the audience. With the consolidation of the past several years in these mega brands. What responses are you getting from existing owners as well as potential owners of properties when they address, well, the proposition from these mega brands is distribution costs, savings, economies of scale and the like, but you become suddenly a small fish in a big pond with the potential to have a competing property in the portfolio right across the street that is not covered by an area of protection because it's not your brand. It's similar sector. You used to compete against them. Now they're your relative.
That's actually very interesting. Obviously, this is coming up much more at the moment. And again, without generalizing, back to Jad's point, you will have owners that place a lot of importance to the relationship and to their ability to access the management team, but also to the fact that it is rather a small company versus a large company. And you have clients that are very much into actually operating within a bigger scheme. It is client-driven, the preferences, and back to the context of the city, the market, the country that will define whether you should go with a local or regional operator versus an international one. But today, the truth is, in an example that we are looking after a mixed-use development that we had 5 competing brands a couple of years ago, and today we actually have 6 out of 7 hotels that belong to one company. Now, from 500 keys competing healthy to 4,000 keys under the same company, it is different segmentation and different branding, but the truth of the matter is how is it going to be done? Oftentimes when we speak about the positioning, we don't necessarily talk about the target markets. We talk about more of a look and feel of the product, what to expect. Is there a differentiation and what each brand is appealing to? Is everyone appealing to the corporate market? Perhaps some brands are appealing to the all-inclusive. This is a real differentiation. It is becoming more challenging in the spirit of trying to understand that while these mergers and acquisition look really good and they're definitely beneficial to the operator because that gives them scale, the impact it has on the owner and their ability to not cannibalize but to generate more volume.
And as you say, if it's 4,000 or 5,000 rooms, no distribution system can manage that. It's going to naturally be cannibalization.
That's true. I mean, another important aspect of, let's put the contracting for a minute aside, be it franchise or managed, is the partnership in terms of profit and losses. As I mentioned today, owners are offended in bad times when market dynamics do not help them generate the right profit, and they see the operator still taking a base fee, a marketing fee, an incentive fee. Sometimes incentive fee is a flat one, it's not rational, it's not related to the profitability of the hotel. And they approach the operator and share with me some of my losses, I mean, at least for a year or two, and the reaction is always a bit difficult when it comes. It's because of the structure of the company, because of the fear of if they do this to that owner, they have to do that to the other owners, and they end up, of course, losing a big fraction of their revenues. This is one of the things that's frustrating the relationship, and I go back to the bad times. In good times, there are no major issues. It's a matter of a little bit more profit here or savings there, but when the hotel owners or the investors are not getting their return to pay back the bank, this is where the stress steps in and start being a burden to the operation and to the relationship with of both parties.
When you pull the contract out from the drawer, which you haven't looked at for many years.
The contracts are sealed very well.
Yeah.
Let's be realistic. They're not easy for the owners.
No, they're not, and this is something that I find. You have, for example, these consolidations. That's a material change, economic change to the relationship. But you're asking me as an owner to stay true to a contract for 20, 25 years, even though my economic circumstances change. Maybe the best use of my asset is no longer a hotel, but I'm stuck to this. But you, operator, can be an economy hotel group suddenly go out and acquire luxury and spend the money I've been giving on you, focusing on developing an entirely new brand. And that's not why I joined in the first place.
But it doesn't apply across the board. I repeat that there are a lot of brand owners and operators that have been flexible in bad times. They have shown this kind of cooperation to ensure that the owners sustain with them until good times are back. So it doesn't mean that they always take the contract from the drawer and use it against the owner. They are always good operators, but as I said, it all depends on the times of negotiation and what changed after that.
Yeah, but I mean, also adding that today, when we're looking at these contracts, to be very honest, pretty much every operator in this room has become very competitive. Even the more difficult ones, 5 and 10 years ago, they have become competitive. So it's not a function anymore, at least I'm talking out of our experience with all the contracts we're negotiating. It's not anymore a management and an incentive fee. Pretty much everyone will end up somewhere similar percentage-wise. It is ultimately about the NOI that each operator is going to deliver. It is about the investment you do initially upfront, and it's about this relationship. How are we going to protect something 10, 15 years from now that, you know, if your circumstances changes, that doesn't impact my investment because I'm taking a loan over a 15 and 20-year term. So this is where more of, I think the future is more really trying to work out these clauses versus the traditional base fee and incentive fee.
And you've partially seen that in the
Right,
what we see
which-
up and
yeah.
behind us. Do we have some other questions here? Yes, in the back. Can you, Jennifer, can you give the microphone, please? Maybe you can speak up. Maybe you have a good voice.
Thank you guys for the debate. I was hoping Jennifer was in the room. And the franchise topic is very important for, thank you, it's very important for a lot of brands and owners today. But I was wondering, maybe, I don't know if we can put the slido.com and take a toll. We've got a lot of owners in the room. And is there an appetite for for owners today in Saudi Arabia, and I'm in the Middle East, will they prefer to franchise, or do they still prefer to, after the investment, get an operator, international operator, regional operator to take it over? So what is the preference of owners today to kind of see where because a lot of the brands are franchising now, whether it's Marriott, Accor, Hilton, all the international brands and regional brands. So where does the appetite sit today?
Well,
Well,
you
Frank-
need answers from the audience, but that's again a question that highlights the background of each owners. If you have owners, if you want, right now, my answer as representative to an owner, I'll go for franchise because of the situation right now and the know-how that we have in managing certain properties. But it doesn't apply to everyone. Some owners are new to this or fairly new to this that they wouldn't want yet to manage themselves. Yes, they might want to appoint a third-party operator. It is one of the good options. But also others that have a very good experience with managed hotel, they might want to do that. What is for sure is new owners have to go for a management contract at the beginning for them to later, and then it could be bound to a period of time, then change it to franchise. The franchise option is there, as Hala mentioned. So, sorry, again, I'm not trying to stop the vote, but the answer has to be clear, not only preference, but only the reason behind the choice.
Right.
No, I think you've answered it. And I mean, profitability-wise, franchise is more profitable for the brands as well.
And I agree, and it comes also with the responsibility of operating, and franchise is a great option. A lot of operators are doing it, but I thought it would be very interesting, and maybe when Jennifer comes back in the room, to see, like we voted, I don't know, on brands, to have a poll. How many owners prefer, or percentage of ownership today prefer to franchise?
We can do that
Yeah, we
right
can do
now.
that. But can I just add
yes.
to this, because I've worked across Europe, Asia, and Middle East, and we do a lot of work in the States. And what's happening today, and you've been in Russia and you've seen that, It's only relative to the market cycle. Today, yes, the operators are willing to franchise because there's more maturity. There's more of a mature investor, and the market is more mature. 40 years ago, in the US, all contracts were management contracts, and then they became franchise, and then Interstate came on board as a white label or the manager. Europe was the same. Started with management. My view is that in 10, 15 years from today, obviously there will be much more franchise. But until we learn, I think it's a market cycle, but a learning exercise as well. Owners need to learn how to manage their assets to that point where they can franchise.
They need to learn not to think that they know. I'm sorry, just to say it like, because many have that confidence that, no, we can manage. It's not correct. Managing a hotel is not like building it.
It's a lot harder than it looks, and quality standards are highly susceptible to gravity. Keep that in mind. But the old adage, well, the market's not mature enough for franchise, is not entirely true anymore. I saw that in Russia. You're looking in Africa today, the brands are willing to franchise there because the fact is they can't staff them adequately. And the most important thing of a successful hotel is getting a general manager who's got the skills and knows the market. And you've got probably a better chance of doing that through a franchise or a third-party manager than you do through a brand.
Yeah, that's true. I mean, that's the case for our business in Africa, where franchise is more relevant. But as you said, because the operator don't want to be there, it's not really a choice. Here, the question was, would the investor or the owner wants a franchise? There is actually the operator saying, we don't want to touch it. We're happy to franchise.
So yeah, you've got a Hilton, young aspiring Hilton GM manager. We're going to send you, we'll make you a GM and send you to Accra somewhere. No thanks, I'll change my job. And, no. Yes, this gentleman, finally.
I think one important factor between franchising and management for a hotel company, not to call it a brand, is where this company want to have their flag and on which building. And the best example we have witnessed the last 6 months are in Abu Dhabi and in Dubai. The same company that was deflagged flagged another property and deflagged from management and flagged another property into franchise. With the experience I can share with you in having worked as owner of a property or several properties with an owning company, developed and built hotels, then having operated under a chain, then moved in and having become the operator as a franchisor and also as management. Each one has its own specificity. What is important today and what we see emerging in our marketplace, Middle East and North Africa, the Arabic-speaking countries, education in the new millennium is different than what we had in the 70s and 80s. In the 70s and 80s, hotels were owned by government. Obviously, it was pure management. And hotel companies were pretty much snobbish. And hotel companies were pretty much tough. Today, owners call the shot. There is no two way about it. Today, owners call the shot. An owner walks into a property and says to his operator or calls his regional office, I don't want this GM, take him out, even if it is as per management agreement. And guess what? The operator says, yes, sir, with a great pleasure, and that particular GM is looking for a job.
Poor guy.
Moreover, what is important is to have a brand and an owner, and then we have two types of operator. The operator that is the owner of the brand or a regional operator. And this is what is emerging today in the marketplace. Nobody knows Mecca adra bi shi'abha. Nobody knows the place better than those of the place itself. So in this case, what is important and emerging for the next decade, and what I can see and experience and witness and realize and motivate in the future of hospitality development is we need a brand as a franchise. We need a regional company that has the know-how and the experience to operate. And I learned this 30, 5 years ago from the States. So the importance of this is to maintain the role of the owner-operator of the brand, the owner, and then are we going to have the operator himself owner of the brand, or a local company, a regional company to operate? Thank you.
Yeah, I think it goes well put, and then it goes back to, yes, the localization element. We are out of time.
Yes. And if everyone would like to head to the reception afterwards, sorry, I'll just let you finish, Scott.
So I think we've seen today that there is many considerations in considering what model to choose, which brand to choose, and how you run your property, and the fact that certainly in this market, the localization element and having that expertise is very important, as much as choosing the brand. I'd like to thank Hala and Shad for joining us, and we can take questions afterwards. So thank you, everyone.